Just about 2% in March meeting, the Federal Reserve has upgraded its forecast for the terminal Fed rate to almost 4.5% in September meeting. So in the last three meetings, they were massively increasing their forecast for the terminal rate, but in the November meeting, they did not change the dot plot. They kept the terminal rate at 4.5%, which means the Fed is also beginning to look at possibility of slowing down the pace of rate hike and also maybe at some point pause. I spoke about how I expect the inflation, how, so in the last slide, I spoke about, we will look at how the US inflation is expected to slow down. So the US inflation story is basically in two parts. The first part of the story is the inflation in US because of the COVID. And then the second part of the story is because of the Russia-Ukraine conflict. You can see on the left-hand side chart, the two signature items which had the highest contribution to the US inflation in the COVID time was due to the prices of the second-hand car and because of the lumber prices. So after the COVID lockdown, everyone wanted a bigger house and everyone wanted a private transport. So there was a huge demand for the cars. That was the time when the semiconductor chips were in short supply. So the prices of the second-hand car shot up. Uh, Not very, uh, known to us, but the second-hand cars have a huge contribution in the US CPI. And then everyone wanted a bigger house because of the work from home environment. So the cost of the input material for the housing prices shot up. And that is typically represented by lumber or the wood. And that you can see the blue line, which is the price of the used car, has come down significantly in the last few months. And the price of the wood has also fallen significantly. Same is the case with most of the other material. So at one point, almost 70% of the US CPI was contributed by these two items. Both of them have come down. So you can clearly see that the inflation due to the COVID-related factors is beginning to phase out. And then the second part of the story was the inflation, which came because of the Russia-Ukraine conflict. And immediately after the Russia invaded Ukraine, the prices of all the commodities skyrocketed because of the panic and uncertainty. All of us know by now that Russia is one of the largest exporter of crude oil and the natural gas. So the fuel component prices went through the sky, and then Russia and Ukraine between them are amongst the larger exporters of grain, basically wheat and corn and everything. So the wheat and the corn prices also shot up. You can see the orange line, which is the fuel inflation. In the last few months, the fuel prices have fallen sharply. So we know that the crude prices have fallen to $87 now from a high of $130. That is reflecting in the orange line. If you were having this discussion 3 months back, one would be tempted to think that by end of November, when Russia stops supplying gas to Germany, there will be blackout in Europe in the winter season, and there will be a crisis, no electricity in Europe. None of those things are happening. The natural gas price is stable for the last couple of months. So again, the fuel prices have come down. That should help bring down the inflation going forward. And you look at the blue line, which is the food price. So the food prices are still high, but you look at the end of the blue line, it is beginning to slope downwards. That means the food prices are also beginning to ease. So if you look at the breakup of the inflation, as I said, just to recap, two parts: due to COVID and due to Russia-Ukraine war, COVID-related factors are subsiding, and the Russia-Ukraine factors are beginning to also subside. I'll give you another indication that there is a United Nations Food Index, and you can see the red dotted line after going up for a long time. In the last few months, the index has been coming down and it is now approaching zero, which means again, globally, the food prices are beginning to come down. Another slide to give you more insight into what is the composition of the inflation. I have taken prices of some important commodities and I have given you three columns there. So in the rightmost column, you can see the percentage change in the commodity prices from the 52-week high. So when was the 52-week high achieved for most of these commodities? Immediately after the Russia-Ukraine war. And you can see from the chart that the energy prices have fallen 32% from the 52-week high. Aluminum prices have fallen 45%. Steel prices have fallen 30%, and so on. So every single commodity has fallen significantly from its 52-week high, which was achieved in March, April after the Russia-Ukraine war broke out. So the panic which set in after the war is now subsiding, and most of the commodity prices are coming down, which means that the central banks don't have to worry about a runaway inflation. They are expecting the inflation to start behaving better. Then if you look at the last 1 year change, which is the first column, from October 2021 to October 22, if you take out the top two, bottom two items, then you again can see that prices are falling everywhere. Aluminum prices are down 19% in the last 1 year. Zinc prices are down 17%. Copper prices 22%, and so on. The nickel prices have gone up by 13%, but nickel has a very small weightage in the CPI index, and nickel is again a metal used for electrical vehicles and etc. So that's a unrelated factor. But steel prices have come down 38% in the last 1 year. So except for the top two, bottom two, which means fuel and food, all the prices have eased. Therefore, it should start reflecting in the inflation in the coming months, right? Except for the food and fuel. Now, if the economy is slowing down, but overall inflation is beginning to ease, it is not expected to go up. That gives the central banks a little bit of room, elbow room to start thinking about slowing down the pace of the rate hike. And therefore, you can see that if the core inflation begins to behave, then central banks will have a little bit of room to slow down. So what we have also seen is a little bit of divergence in the comments from the different Fed people. Some Fed members are now saying that the Fed should continue to tighten rates until the inflation comes down. Some people are saying that, okay, we should wait for some time to see the impact of the aggressive hikes that have been done in the last few months. Some people are saying that no, we should stop hiking rates. So what does this divergence mean? If different people from Fed are saying different things, it is not random. It is a orchestra which is playing, where different instruments are playing their role, because that is their way to communicate to the market. If you go back to January, February, when the Fed was about to start hiking rates, we saw people talk two different languages. Then there was a phase of 4 to 5 months where anyone talks from the Fed, he says that our top priority is inflation. We should continue to hike rates until the inflation is coming under some control. So this noise or different statements from the Fed people are now suggesting that maybe the Fed is looking at slowing the pace of rate hike from 75 to 50 basis points, maybe one more hike, and then they are looking at pausing. We saw similar situation in RBI also. If you remember, just before the RBI hiked rates in May, before that, Jayant Verma dissented in the MPC. Before that, Asima Goel, another MPC member, said that we should normalize the policy. So, well before the RBI hiked the rates, the members started giving the signals that now the RBI is ready to hike. Now, in the after the last policy, we have again seen Jayant Verma dissenting. He's saying that we should see the impact of the rate hikes which have already been done. We have again seen Asima Goel dissent last time and saying that no, we should not hike by 50 basis points but by 35 basis. So this is not that Jayant Verma is actually dissenting. In my view, this is an orchestra. So Jayant Verma is playing his role. He is giving you an advance signal that prepare for this. At some point, we will do this. So if the market moves in line with the RBI expectation, then RBI will possibly slow down. Same kind of messaging is coming from Fed now. So this is the overall heat map of the US economy. You can see that last column, everything is in the red. So US 10 to 2-year spread has fallen to 50 basis points negative now. It is from a high of 80 basis points to minus 57. It is suggesting that the market is expecting a recession in the coming months. The mortgage index has fallen from 552 to 200, right? So housing prices in US have begun to come down. A lot of people that I speak to in US 2 years back before lockdown started, they bought some house, the prices went up by 25%. Now they're saying that if I sell my house today, I'll hardly recover my cost. So there is housing price correction that has happened. In some cases, and some friends I spoke to, their mortgage rate has gone up from 2.25% to 7%. So again, the amount of money available to them for consumption is beginning to reduce. You look at the US composite PMI, which is the last but second line. So second line from the bottom, the PMI has fallen from 61 to 48. 48 is in the contraction zone. So from a highly optimistic and positive expectation, market is now beginning to feel that the recession is close by. Right? Now, if you look at the unemployment rate, it is still very low, but it is beginning to go up. And as we discussed, there are layoffs happening in the big tech sector, which will have a contagion effect. So the unemployment rate has possibly bottomed out. And then if you look at the first row inflation, inflation is at 7.7%, which is still very high, but it has fallen from a high of 9.1%. So as I was telling you, the impact of the Russia-Ukraine, you see, January 7.5, it went to 9% in June. And then, as I showed you in the previous slide, as most of the commodity prices started correcting, it has come down from 9% to 7.7%. I expect the inflation to come down to about 6% by March. So again, things are beginning to stabilize, things are beginning to improve, and therefore, if you again look at the overall situation from a very negative situation, situation has begun to improve, and during this time, Federal Reserve has increased the rates from 0 to 4% now, and now in the next 3 months or next 6 months, if the inflation falls to 6% and the Fed goes to 5%, then there is a room for them to take a pause, right? So overall, we have discussed about these things. Now, if you look at the Indian economy, our Indian economy is in a very strong situation. We are in a sweet spot. Our consumption story is very strong. Everyone knows that India is one of the best economy in terms of the growth prospects right now. There is universal acknowledgement. Any expert, any analyst you talk to will say India is one shining star. But we still have challenges from the global side because domestically we may be very strong, but we are an interlinked economy with the rest of the world. If the rest of the world has problem, it will have impact on us. We have already one of the record current account deficit. We have had trade deficit of $26 billion last month. Our exports have shown a little bit of contraction in the last month. So there are challenges, but overall, Indian economy is in a very, very strong position. You can see that the growth numbers are looking very, very strong. Growth is reviving. At times, our headline inflation, headline growth number is not very, very attractive. So still, the domestic Indian economy story is very good. What we are seeing right now is the disparity between the urban lifestyle and the rural lifestyle is narrowing. That means that people in tier 2, tier 3 cities, let's say Indore or Jabalpur or Bhopal, even in the smaller cities, earlier people used to have a lot of money, but their lifestyle was still very simple. Now people are upgrading to a better lifestyle. Now, whatever you have in Kolkata or Bombay, you will find a Domino's in Jabalpur, you will find a Pizza Hut in Indore, you will find a, Louis Philippe showroom in all the small places. A few months back, I went to a small place called Silvassa. Silvassa is a sleepy, small industrial town. There are a few factories. I went to inspect a cable factory, telecom factory. Naman and View. So there is the cable factory of Sterlite Technology. So just from highway as you enter Silvassa, right there's a huge mall with multiplexes and everything. and then we went for lunch. I mean, there is as good a restaurant as you get anywhere in Calcutta or Bombay. So with the availability of these facilities, with the digitization of the Indian economy, with the today whatever you want, you can order from Amazon and they will deliver in Calcutta or in Patna, right? So the availability has improved, the logistics have improved today because of the digital revolution. Information is available everywhere. The UPI, phone pay, and all these digital apps have made payments very easy. So the gap between the urban lifestyle and the tier 2, tier 3 city lifestyle is narrowing. That is giving a boost to the consumption. And then there is an improvement in the disposable income of the next level of people, and that is improving their spending pattern. People are now buying branded clothes, people are now buying branded soaps, and that is again leading to huge improvement in the consumption pattern. So there are two levels at which the consumption story is changing. One is that people who always had money but who typically lived a very simple life, they are now becoming very uh, aligned to this urban lifestyle. And then people whose income levels are improving, and they are improving their lifestyle, and that is giving a structural thrust to the Indian economy. Now, GDP of any country is largely made up of three parts: capital, capex, consumption, and exports. So our consumption story is very strong, but we have a challenge on the capex side and on the export side. Our exports are one of the biggest challenge. So we saw a huge uh, boost in the exports. Last 1 year, our exports have done very well. For the first time in our history, we have done $400 billion of exports in FY22. Now, why the exports have again slowed down? Now, if you go back to the second wave of COVID, that was the time when the economies like US and Germany, European economies were opening up because they had just given vaccine to enough number of people. So they were opening up, but that was the time when countries like Vietnam, Thailand, Philippines, uh, who are the large exporters to US, they were witnessing their first serious outbreak of COVID, like what China is having now. So on the one hand, advanced economies like US and Europe are opening up, and these economies were shutting down. So India suddenly became a country which found this opportunity. So our exports boomed because India was the only country in the second wave where not for one day any industrial activity was stopped. In the second COVID wave, the entire focus was on restricting individual mobility, but the industrial units were allowed and given all possible help to continue producing. So we suddenly saw a huge jump in our exports, and then we had the Russia-Ukraine problem. The government banned export of wheat. Then government put an export duty on steel, and so many things happened. Now, again, the government is beginning to relax some of that. Government has now withdrawn the export duty on steel. Government has reduced the windfall tax profit on petroleum products, etc. So hopefully the exports will improve, and because our domestic economy is so strong, we are seeing a huge flare up in the imports, and that the crude prices on a net basis have gone up. So crude prices are up from about $70 last year to about 85 to 20%, and then rupee has depreciated by 10%. So effectively, the oil prices, right? So India is one of the largest importer of oil. So that is giving a little bit of challenge to the net exports because the imports of those items are going up. So point I'm trying to say is that even if our headline GDP number is low, 6%, 6.5%, 7%, that still is a very strong number. That is still giving us a very good vibe or indication for the next 3 years, because the government is collecting revenue because of the tax reforms, because of the GST reform, because of the better compliance. Our government is able to now collect 1.5 lakh crores of GST every month. Till last year, it was only 1 lakh. So 50% increase in revenue collection. So this year, until September, we have done only 37% of our budget estimate. The only challenge is that whatever extra revenue government is getting, it is spending on revenue expenditure. So government will introduce some other Kisan Samman Yojana, or they will continue the free food program. So lot of this improvement in the revenue is being spent on subsidies and you know uh, help to the poorer section of the society. But maybe that will lay the foundation for the continued growth into the future years. So whichever way you look, as I explained to you, change in the lifestyle, improving expenditure. Government is spending a lot of money on infrastructure. So we have better roads now, we have better ports now, we have better airports. I mean, who would have thought that we will have a airport at Durgapur, right? So many people, suppose if someone has to come to Durgapur for a marriage or Asansol or Raniganj, lot of people will avoid because Calcutta jayenge 5 ghanta train. Now if they can land directly at Durgapur, then they will in the mental torture, right? So if I have to go to Durgapur for a marriage, I will come. But if I have to come to Calcutta, then spend the night here, take the next morning train, I say no, avoid it. And when those kind of people come to those places, those economies grow, their lifestyle, aspirations change. So a lot of these changes are happening. And in the right hand side, you can see the chart, how the government has improved the revenue collection. So in the box, the blue line is the average tax collection in the last 10 years. And the green arrow is how the government did in the last year. And red dot is how the government is doing in the current year. So you can see that on all items, whether it is income tax, corporate tax, or GST, the government is collecting far better than the average in the last 10 years. So the excise is the only one where the current year's collection is lower than the previous year or closer to the average, but that is because the government had reduced excise duty on petroleum products. So obviously the customs and the excise duty collection will fall. But look at the look at the GST, which is the middle third item. The average is blue, and then green is the previous year, and red is the current year. So government is getting more and more collection in the GST. Same thing with the corporate tax. So our financial situation is improving dramatically. That is again a positive indication for the coming years. So what are the leading indicators for us that should prove positive? First of all, and most important, the inflation has begun to ease. If you look at the red line is the upper band of the RBI's target for inflation at 6%. And then you look at the green dotted line, which is the RBI's lower band of the inflation target. And if you see that in our case, while the inflation has been on the higher side, in case of RBI, compared to a target of 6%, the inflation is at around 6.77% now and expected to fall to 5% by April-June 2023. Whereas in rest of the world, for example, for Federal Reserve, the target inflation is 2% and actual inflation after easing is at 7.7%. So there is a lot of comfort that RBI is in. Next slide, I'll show you how what that means. And then if you look at the growth expectations, the orange line, which is the India's PMI trend, our PMIs are still going up, which means the public is very, very optimistic and positive about the future of India. And if you look at the blue line, which is the global PMI, it has been coming down and it is at the low point in the current cycle. So while the rest of the world faces a prospect for recession, Indian economy seems to be in a very, very strong situation. Again, the way India has come out of COVID, if we had a COVID-like situation 10 years back or 15 years back, Indian economy would have been decimated. But the way we have dealt with COVID, because of that, today India is expected to be the fastest growing economy in the next 3 to 5 years. And now, the way we have handled the Russia-Ukraine situation, the way we have handled the energy crisis, the way government was quick to put export ban on wheat, those all things have helped India remain strong and get into the limelight. And now everyone is expecting India to do very well. So there are positive indications both from the fiscal side and from the inflation side, and therefore we can feel a little more comfortable with the current environment. You can see from this slide that our real rate is already positive. So RBI is expecting the inflation to be 5% in the April to June period. If that happens, then our real rates will be positive by almost 90 basis points. But even if I assume that inflation comes down to 5.8%, which is the projection for the January to March 2023, our real rates will still be positive by minimum of 10 basis points. So apart from Brazil and China, most of the world has a hugely negative interest rate, whereas Indian interest rates are already coming very close to the positive. So that again puts RBI in a very strong position to basically conduct monetary policy going forward. So if you consider all this, then you say, okay, what does it mean for the interest rates? What does it mean for investors? Where should they invest? What kind of products they should look at? And what is expected to happen? So let me just recap what we have discussed. First conclusion is that the central banks have hiked rates very aggressively in the last 6 months. Most central banks are now beginning to send signals that they will either slow down the pace of rate hikes or they will gradually move to a pause. At this point, there is no indication that the interest rates will come down in a hurry or in a quick time. Expectation is that by March, which is 3 months from now, most central banks will have been done with rate hikes and then they will be on hold for the rest of the 2023. In that scenario, it is unlikely that interest rates will fall in a meaningful manner, but most likely scenario is that interest rates will remain at that level for most of 2023. The second conclusion that we had is that what central banks are indicating is also supported by data. Like we saw how the US inflation is divided in two parts and how each component is giving us a clear signal as to how the inflation has peaked and the inflation will begin to ease. We also saw that in so far as India is concerned, we are in a very strong situation. Our economy is expected to continue to do well. Even if the headline GDP number is little bit on the lower side, it does not affect the structural story that India is. And finally, we saw how India is already well ahead in terms of the real interest rates. So RBI has done a good job. Very quickly, they have hiked rates. Now, what has been the impact of the rate hikes of the Reserve Bank? So you see there are three lines. So one is the August 20, which is the bottom of the interest rates in India. And then December 21 is the orange line. That is where the interest rates were when the Fed gave a first clear signal that they are going to hike rates. And then the gray line, which is at the top, is the current level of the interest rates. So something which is very clear from this, that once the Reserve Bank started hiking rates, the short-term rates have moved the fastest and the most. So 1 month T-bill, 1 year T-bill, which was at 4% roughly, just when the RBI started hiking rates, is now at close to 7%. So the 1 year T-bill rate has moved by a massive 3% in the last 6 months. What has happened to the 10-year rate? If you recall, even more amazingly, when RBI first hiked rates in May, that was supposed to be one of the most shocking U-turn by the Reserve Bank. On that morning, 10-year yield was at 735. And today also the 10-year yield is at 735. So the 10-year yield had already moved. Yes, in May. On that day, 10-year yield was at 735. But it closed at 735. And today also it is at 735. So I think one of the very important observation is that like in the equity markets, the markets are already working on the earnings projections for 2024. In bond markets also, market prices the known macro developments much in advance. Let me give you two more examples. In US in March 21, when the Fed Fed was still welcoming some inflation when US inflation was at 1% only. The 10-year yield in US had already moved from 0.5% to 2%. Even before RBI started hiking rates, the 10-year yield in India had bottomed at 565 and it had already moved to close to 774. And we are seeing it happening live. You see in Germany, the 10-year yield was at minus 0.75. Now it is already close to 2%. It had gone up to 2.25% also. Even before ECB is beginning to just about hike rates, ECB has hike rates by just maybe 1%, and already the 10-year yield in Germany has moved. So markets don't wait for the central bank to take action, they move ahead. Now, what happened in case of India is from the day of the first rate hike, what happened in case of US is 10-year went from 0.5 to 2, then it waited for better signals from the Fed. And now it is at around 4%. It went to 4.5 also. Now it is at 370, whatever. In case of India, from the day one, when the first rate hike happened, market expected the terminal repo rate in the current rate hike cycle to be 6.5%. Now at 5.90 with another 50 or 35 basis points rate hike, by and large, 6.5 looks like to be the terminal rate in the current rate cycle. So if you take the normal repo rate to 10-year spread of 100 basis points, market would expect 10-year to be somewhere around 7.5. And that is where the 10-year has held at the level of 7.5 so well, because the terminal rate expectation for RBI at 6.5 has not changed from the first day of rate hike. Whereas in US, like I showed in the second slide, how the terminal rate expectation of Fed has changed from 2 to 4.5% just in the last, which is why the 10-year first took a stop at 2%. Now it has gone to 4%. So therefore, if you believe that RBI will stop hiking rates when the repo rate reaches 6.25 or 6.5, then 7.5% for the 10-year rate is a very, very strong resistance, very strong level where one should start accumulating. What will happen when the Reserve Bank hikes the rate from 590 to 6.5 is maybe the short-term rates will go up further. Now even the 1-year T-bill is factoring in a repo rate of 6.5, so it has gone up to 7%. So but by and large, the long end will not have that much volatility. So from a very steep yield curve, where the difference between the 3-month CP of 3.5 to 10-year at 7% was 3.5%, it has narrowed down to now almost just about 25 to 50 basis points, where 1-year T-bill today is maybe 680, but overall I'm just saying broad big figure, 7% 1-year T-bill to 7.5% 10-year G-Sec. So the yield curve is very flat now. And the market is beginning to expect that the Reserve Bank will stop at 6.5, then it will remain at 6.5 for close to 1 year, and then maybe there will be some possibility of a rate cut. So in this environment, how should we position ourselves? What are the good products? What are good maturities to have? So if you look at a flat yield curve with an expectation of the rate hike cycle coming to an end, 10-year is still very volatile and there are a lot of uncertainties. So there are a lot of risks. For example, Russia-Ukraine can have an escalation in the situation. There can be a nuclear war. There can be further, intensity in the attacks and all that. There is a challenge on the China-Taiwan front. There is still ongoing tussle between India and Pakistan. So geopolitical situations can become volatile. Iran, Israel, and there is a bigger challenge in terms of the US and Saudi Arabia not getting along. So Saudi Arabia did not increase production in spite of the US request. And then in the last week, you would have read the news that the US has granted immunity to the Saudi king from any prosecution in the US courts. So there is obviously some give and take. These are the kind of news that you have to understand, why things will be different. Like we gave you the breakup of the inflation between COVID and post-COVID and how the underlying components are moving. With that kind of analysis, you have very high degree of confidence in your view. So if that improves, now if the US is giving that concession to Saudi Arabia, one can expect that Saudi Arabia will cooperate a little more with US. So possibly the oil prices will remain low But then if the crisis escalates and the oil prices go up, when China opens up, that could again lead to some bounce back in inflation. So from a very, very negative situation, we are moving towards a neutral situation. It is still not an environment where we can start feeling overly confident and positive. So you don't want to take an aggressive duration call right now, and you don't want to start jumping into the dynamic funds and aggressive funds and buy 10-year bond and all that. That is still a trading opportunity. It's not outright aggressive call. But if you remain at the short end, 7% in 1 year T-bill or 2 year paper, if the environment improves and the inflation comes down in a hurry, like the market did not wait for the RBI before the rates went up, the market will not wait for the RBI to cut rates before the market rates come down. You are already seeing why the floating rate fund as a category has not performed. Is because when the floating rates funds were launched, swaps were already rising, and the spread between swap and GSEC was positive. Now, we are just about beginning to start the view that the central banks may have done with the rate hikes. The swap rates are already lower than the GSEC. So the markets move ahead. So if you are too short in duration, then by the end of next 1 year, when the rate cuts may start, you will be missing out on the opportunity. So to address the uncertainty and to be able to maximize your participation, the 5 year point on the yield curve looks the most attractive. If you are at the 5 year point, then you are having enough duration to participate if the markets become positive and avoid any huge loss if the markets turn negative. Within the 5 year duration, there are a range of products that fit into that. You have the short-term funds, which fit into that. You have the corporate bond funds, which have a high credit quality that fit into that. And now there is a very interesting product, target maturity fund. And everyone knows it's a no-brainer that the target maturity fund is a superior product of all options in that segment. If you invest there, if the rates go up, then you don't have to worry because at the end of 5 years you get your money at 7.5%. If the yields come down in between, then you can put your capital gains whenever you want. And, if you have a short-term investment horizon, then I think the low duration category is looking very exciting to me because yields have already gone up. Market is already pricing in at 6.5% repo rate. So that is now looking very, very cheap. So low duration funds, in my view, will perform the best in the up to 1 year category. In the 3 to 5 year category, I think short duration and corporate bond funds for people who want to take an aggressive duration call, and the target maturity fund for people who want to have safety and possibility of participation. So that's it from my side. I'm happy to take any questions, feedback, any views from your side. No, no duration, but RBI policy, everyone knows that there will be a rate hike. 35 or 50 is the only debate. So if it is 25, तो फिर low duration में घुसने का मौका भी नहीं मिलेगा. If it is 35, 50 हुआ तो there will be no impact in the market. Yields will only come down. Today, 1 year bank CD. Yesterday we bought Bank of Baroda CD at 7.5% money. That's pretty. So already you are seeing demand in spread.
जाजू जी, how are you? कमल रामपुरिया.
कमल जी कैसे हो?
एकदम बढ़िया सर, आप कैसे हो?
All good. So nice to talk to you.
Yeah, so nice to see you and talk to you.
Thank you, thank you. मैंने देखा आप शुरू से कॉल में थे, तो I thought I'll talk to you later.
Yeah.
Already देर हो गया था ना.
हाँ सर, ये कीजिए, आपका पीपीटी हटा दीजिए so that I can see you.
हाँ. नहीं.
Yeah, that's better.
संजय जी, how are you?
कैसे हैं जादू सर?
बढ़िया बढ़िया, एकदम बढ़िया.
और बहुत दिनों बाद दर्शन हुआ आपका. देखिए बॉम्बे वाले कलकत्ता में मिल रहे हैं.
So Jajuji, I have a question. Not a question, but just a interaction. So, it all started, rate hike and all this all started with starting from a global factor to inflation and all this. Is there any study available? What has been the impact on the reasons why these rate hikes happen, and how much are we in control of that? Or going forward, it will become less meaningful?
Yeah, I'll cover that. So before that, there was a question that the spreads of the corporate bonds has come to almost zero. So in that situation, what should be done, and why the corporate spreads have come down? So basically, the corporate spreads have come down to zero because there has been a short squeeze on the supply side. So if you remember, 2-3 साल पहले हर महीना REC, PFC, Exim सबका इशू आते रहता था. Last 1.5 year, practically there is no issue from this side. अब जाके नाबार्ड जैसा आदमी तो हर 3 घंटे बाद नया CPI आ जाता था, उसका इशू नहीं आ रहा है. So if you look at the statistics, last 1 year, last 12 months, the net corporate bond supply is only 13,000 crores in the market. Right? I was reading some data yesterday. So the net supply is gross, जो maturity है, उसका rollover is just about 0.04% something. So इतने बड़े market में where insurance companies, pension funds, LIC, they are growing at 25-30% their balance sheet. There is no new supply, so there is a short squeeze. Then there is so much of the FMP, then this target maturity fund now, and so supply नहीं है, और there is a huge demand, and because of which the spreads have come down. अभी समझो हमने एक target maturity fund कर रखा है, 50% ट्रिपल एपीएसयू, 50% एसटीएल. ट्रिपल एपीएसयू में सप्लाई नहीं है, 5-10-25 करोड़ माल लेने में बहुत मुश्किल हो जाती है. यू पीपल आर द एक्सपर्ट्स इन द बॉन्ड मार्केट. आपको पता है सेकेंडरी मार्केट में अभी सप्लाई नहीं है. सो द स्प्रेड्स हैव कम डाउन बिकॉज ऑफ दैट. नाउ द सेकंड पार्ट इज फॉर व्हाटएवर रीजन द स्प्रेड्स हैव कम डाउन, सो इट्स एन एब्सोल्यूट नो ब्रेनर. आपको भी सिर्फ एसटीएल में जाना है. ट्रिपल एपीएसयू वगैरह एट दिस स्प्रेड हैज नो वैल्यू. Because जैसे हमने डिस्कस किया, the government has been getting very good revenue collection. तो 2 साल पहले गवर्नमेंट डिसाइडेड टू क्लीन अप ऑल दिस बैलेंस. एफसीआई का 3.5 लाख करोड़ का बोरोइंग था, that has become zero. REC, PFC, they have been given 1,20,000 crores. The state electricity boards have been given money to clear their dues with the transmission and distribution companies. So government has cleaned up the entire public sector balance. इनके जो dues अटके रहते थे वो सब recover हो गया. The other part is that because the market pricing was there, so इनके सबके जो under recovery थी वो खत्म हो गई. Right? MSP बढ़ा दिया, etc. So on the one side, the government cleared up the balance sheet. You look at PSU banks today. State Bank is more profitable than HDFC. Business होता था, and so public sector banks now are beginning to participate in the great growth again. So one reason why the borrowing has come down is because of the huge cleanup by the government in funding and the clearing of the dues by the government. Second is last 3-4 साल में कुछ नया ढंग का प्रोजेक्ट ही नहीं आ रहा. The पूरा दुनिया लगा, मतलब after the IL&F crisis, the entire corporate sector is just busy with deleveraging. Everyone wants to become debt free. So fresh borrowing नहीं है. नहीं, there is no contradiction. स्टॉक मार्केट का अपना व्यू होता है. So the stock market is expecting कि 2025 में कैपेक्स आएगा, तो उसका भाव अभी चला दे. See, one of the reason why stock market is so volatile is because stock market is pricing in 3 साल आ गया. अब 3 साल में so ये if what market is thinking, if it happens, then at that time the stock will correct. Or like if you see, like we just now discussed, in case of the Reserve Bank, on day one, market said 6.5% is the terminal rate. So 7.5 हिला नहीं. In case of US, people first thought 2%, 3%, 4%. So first stop was 2%, second stop there was 3%, third stop is 4%. So जैसे जैसे expectations change होता है, market realize. Today you look at the defense companies, infra companies, already some 40-50. I mean, we have seen this happen in 2007-8 also. तो स्टॉक मार्केट का जो वैल्यूएशन है वो इवेंट के पहले हो जाता है. वो इवेंट हो गया तो वैल्यूएशन नॉर्मलाइज हो जाएगा, नहीं हुआ तो वापस आ जाएगा. So there is, which is what I was saying, that Indian economy is in a sweet spot. The market is very optimistic, and for a change this time, it looks like the economy may be able to deliver on expectation. So to come to Kamalji's question as to whether this kind of rate hike, I mean, obviously, I think the Reserve Bank has done a great job. So in spite of the rate hikes, there is no panic in the market. I mean, I can just give an example from the mutual fund side that in the last 1 year or last 6 months, such a massive rate hike has happened. Market has got repriced so much. But you tell me one fund which is showing negative return in 3-month category also. So whether it is gilt fund, bond fund, corporate bond fund, low duration, everyone is showing positive to flat return. So पेन 1 साल के रिटर्न में तो दिखेगा ना. But पेन रिटर्न इज स्टिल नॉट नेगेटिव. जैसे लास्ट टाइम जब ऐसा होता था तो 8% 10% नेगेटिव हो जाता बॉन्ड. दिस टाइम वी आर सीइंग अ वेरी much better behavior. The panic has been much less. So I think RBI has done a good job. Obviously, RBI has, had the backing of the reserve. So when it's the first time, like Reserve Bank said that when there is a problem on the current account deficit front, or when the RBI has to support rupee, they said we have $640 billion of reserve. और ये तो reserve बनाया है for this situation, so we will spend it. So they will spend $100 billion of reserve, and now rupee is stable, Indian interest rates are stable. So Reserve Bank has been using all the tools available at its disposal in a very smart way, and they've been confident, and ultimately it is the confidence that matters. So if people believe that RBI has the ability to control, then it is good. And so far, I think the government at the Reserve Bank has done a good job to give confidence to the market. So I think India is in a good position.
महेंद्र जाजू जी नमस्ते.
नमस्ते नमस्ते.
मैं अशोक शर्मा बोल रहा हूँ.
कैसे हैं शर्मा जी?
बस याद आ गया आपको?
बिल्कुल बिल्कुल.
अच्छा, इट वाज अ वेरी नाइस प्रेजेंटेशन. आपने बहुत अच्छी तरह से समझाया और मुझे वो पुराने दिन याद आ गए जब आप पीडी को रिप्रेजेंट करते थे आरबीआई में और आरबीआई की मीटिंग्स में और पीडी की मीटिंग में, प्राइमरी डीलर्स की मीटिंग में, है ना. तो अब मुझे सिर्फ एक छोटा सा पॉइंट है, जो अभी जिस तरह से फेड का जो एक्सपेक्टेशंस है कि टर्मिनल रेपो रेट, जो उनका जो भी टर्मिनल रेट है वो 4.5 to 5% तक जा सकता है, एंड दे विल बी कीपिंग एट दैट हाई लेवल फॉर ए क्वाइट अ लॉन्ग टाइम. what the indications and what the Fed is saying, and various Fed presidents are also saying, as you have already said in the earlier part of your presentation. So in that scenario, even though the right now our yields are at 7.30 and US yields are at 10-year is basically at 3.7 something, it is hovering around, and their terminal rate or Fed rate is expected to go up to 5% and keep that at that level or whatever level for quite a long time. The rate differential, the risk-free differential between their 10-year and our 10-year plus the hedging cost, will it have any sort of a effect on a currency volatility? Any thoughts or any, can you enlighten us on that, this point, please?
Yes, I think that's a very valid question. I think the difference between the US 10-year rate and the India 10-year rate is a function of two factors. One is how strong is the Indian story, and then how much more aggressive or hawkish the Fed becomes from here. So let me just give you another angle. Forget about all these differences that we can talk later. But right now, what is happening in US, that it is just not that the Fed is hiking rates, Fed is also doing quantitative tightening. They are withdrawing $95 billion per month by not rolling over their holding of the treasury securities. Now, once you complete another 6 months, they will be closer to $1 trillion of the withdrawal of liquidity. And the new government borrowing from the US will continue to hit the market. That is happening at a time when the biggest supporter of the US treasuries, which is the other central banks holding reserves, are beginning to withdraw. So now there are two things that are happening. One is that most emerging market central banks are actually seeing their reserves getting wiped out. Like in India, 100 billions of reserves is gone. Collectively, I think almost 1.2 trillion reserves of $1.2 trillion of reserves of the global central bank has gone out. So the another biggest buyer of the US Treasury securities is gone. Then most of the central banks are now beginning to diversify away from just holding US Treasury securities. For example, now India wants to start rupee trade with Russia and whichever country agrees. China is getting into a very conflicting situation with US over a period of time. They will want to reduce the holding of the US Treasury securities. So that is the trend that is developing. So from a situation where Fed was buying government bonds and the other central banks were buying, now we are going to perhaps see a situation where the Fed is selling and the other central banks are also selling. If that happens, that by itself can put enough pressure on the 10-year yield in US and take it higher. Now, if the 10-year yield goes higher in US because of that reason, then the Indian yield may not get affected, because we are not dependent on the FPIs on the debt side. Our dependence on the FPIs or on the equity side. In debt, the FPI investment is not very large, so if they take out, doesn't matter. At the same time, let's say if this is happening at the same time in the next 6 months or 1 year, if the government bonds are included in the global indices, then we may expect some inflows there. Now, the other part is that as it is, suppose if India's rating is upgraded or the Indian economy receives a lot of the FPI flows, then the Fed withdrawing liquidity may not have good impact on India. So, there are two parts that are happening. One is that US situation is deteriorating. The US treasury demand is reducing and India's fundamentals are improving and India's situation is strong. Then compared to the historical spreads, we may be in a situation where a narrower spread is acceptable. So historically, let's say 500 basis points, and currently we are at about 400 basis points, 350 basis points. So 100 basis points compression may be there because of the worse situation of US and the better situation of India. But if the FPIs start withdrawing from India for whatever reason, then that spread may again widen. My personal belief is that when you talk about spread, market will focus more on the shorter end of the curve. So suppose if there is a currency crisis or the FPIs withdraw money, I think RBI may say for example, have to hike the repo rate to 8%, in which case the yield curve will most likely become negative. Rather than the long-term rates going up, it is the short-term rates go up. But as you rightly said, this is a concern. Anything can happen because today we are very confident about India and its story. In 6 months, if the story changes, then I think we have to be watchful, Sarmaji, of the factor that you mentioned. And therefore, whenever the spreads become too narrow, we should be booking profit and then waiting for the spreads to widen again.
Thank you, Mahendra ji.
Thank you. Possible. See, right now in US, what has happened is that the equity markets have gone up, interest rates have gone up. So there are a lot of pension funds and the insurance companies which are for change finding their asset liability matched. Everyone believes that equity valuations are very high. Interest rates, they were used to 0.5%, 1%. Now they're getting 4%. So that realignment is happening. Once that happens and the demand reduces, then we might see the 10-year go up. Right now, everyone believes that the recession is coming, therefore the yield curve is inverted. So there are a lot of temporary factors which are against the fundamentals. But I think if we look at it objectively, US is in a very bad shape. So the 10-year yield should go up there. So I'm not sure how long this will continue. If Fed goes to 5%, 10-year to remain at 370 is difficult. But if Fed goes to 5% and RBI stops at 6.5%, then our 10-year should be seeing some narrowing of the difference. Currency is now in a happy zone, I think. I mean, look, last year RBI was trying to hold the 10-year at 6%. Market became illiquid, 2 दिन trade ही नहीं हो. Or the moment RBI allowed the interest rates to get aligned with the market, now in spite of all the negative things, 10-year is getting a good support at 7.5. Similarly, where RBI was holding currency at 78, 79, पूरा reserve जा रहा था. Once RBI allowed it to come to 82, now it is left to the market forces. I think it is looking reasonable to me because 3 month पहले, 2 महीना पहले तक जब हम presentation करते थे, हमारा पहला point होता था Indian rupee is the best performing currency in the world. अब वो point drop हो गया because RBI has allowed the rupee to align with the market levels. From here, 95, 85. See, now if RBI allows the rupee to move in line with the market globally, then possible, but clearly the dollar index has peaked. I mean, at 115 to 107. So I right now think 85 looks like a difficult proposition, but see, right 10-year at 7.5, now rupee is finding good support at 82. So we have to see. I mean, our trade deficit situation is very bad. So things can right. I think China is a declining story. So China's importance is coming down day by day. So China growth story has now kind of gone haywire. So we were just discussing that say 5 years back, 10 years back, China में story क्या है कि हमको 10% GDP growth दिखाना है. So GDP में 40% of the GDP was fixed asset formation. So the government will say grow the fixed asset by 25%. 4 port बना दो, 4 airport बना दो, तो factory लगा दो. So if your fixed assets grow by 25%, so 10% GDP growth is guaranteed. उसके बाद consumption हुआ तो ठीक है, बाकी सब ठीक है. Now they have a problem on the infrastructure. Return नहीं आ रहा है. We know the China real estate story. It has gone haywire. China people have the highest percentage of their net worth in real estate investment anywhere in the world. A typical Chinese has 60% of his net worth in real estate. Real estate sector is in a deep problem. So on the one hand, because the infrastructure has reached a certain level of saturation, it is not easy for the government to now say, okay, grow the fixed asset by 25%. That part of the growth is gone. Then their exports mark higher because exports are now facing challenge on two fronts. One is now the labor cost parity is there, so the cost advantage is not there. Plus, China has a lot of political fight with major, powers, with US or with, India. So China has grown very fast, but अभी उनको लगता है कि because they have become big, they should become the superpower. So they are getting into the fight to replace the US as the superpower. That has its own cost and damages. So that is what they are paying. So I think China will become less and less relevant because जैसे क्या रशिया यूक्रेन में वॉर हुआ तो एक महीना मार्केट को बहुत टेंशन थी, बाद में समझ में आया कुछ नहीं. मुझे why the market bottom in April 2020 or May 2020. The market bottom on the day the lockdown was lifted. Once people knew that हो गया lockdown अभी खत्म story तो market picked up. The moment people realized that Russia-Ukraine is over for the market bottom. So once people realize that with or without China doesn't make a difference. So what will happen is that today, like यूके में इतना प्रॉब्लम हो गया, उधर ये हो गया, करेंसी उड़ गया, 4 बार प्राइम मिनिस्टर चेंज होती है, फर्क नहीं पड़ता, यूके का एग्जिट हो गया. I think that China will become the same, irrelevant for the markets in the next 1 year's time. So, and उनका story अब खत्म हो गया. They have again reached a saturation point, and I think the government is getting the policies wrong. The two policies that the government is getting wrong is one, they want to replace the existing superpower. So वो टाइगर फाइट है, कौन जीतेगा पता नहीं, but damage तो दोनों को. If there are two tigers fighting for territory, they posture and then one withdraws. If they fight, then both get injured. एक तो मरेगा, एक injured हो जाए, तो वो भी 4-5 महीने बाद मर ही जाएगा. So then some new tiger will come. So they survive only when one they posture and उसके बाद एक अपना रास्ता चलाते. यहाँ पर दोनों लड़ने को आ गए तो दोनों का डैमेज. यूरोप is anyway dead. So I think China का I don't think future is looking very bright. The second mistake that the government is doing is in handling. I mean, you can look at how India handled the COVID and how China is handling COVID. तो zero COVID में लगे रहेंगे, सब कुछ बंद करके बैठे रहेंगे. That doesn't work. So I think their government is missing the governance smartness. Dictator भी है तो भी सही policy को करे. They have no idea how to handle COVID. In Hong Kong, what they have done, people are now reluctant to go to China. Like अभी आपको बोलो कि आप नाइजीरिया जाके आपको जाने में डर लगता है. So now people are beginning to withdraw China. No one wants exclusive facility in China. So for the first time, Apple now wants to set up its own chip unit in US. So now they have told the TSMC, which is the Taiwan semiconductor manufacturing, that your next plant cannot be in Taiwan, it cannot be in China, it cannot be in India, put it up in US. So Arizona mein Apple is putting up a chip factory. So what confidence in China about being able to conduct business smoothly is gone. And people also say कल को इसका US से फाइट हो गया, US बोल रहा है कि तुम उसको चिप टेक्नोलॉजी नहीं दे सकते. Overnight US government वो बीच में WhatsApp पे बनाया कि they asked all US employees in China to resign. Now that was WhatsApp rumor, it can turn out correct. If there is like today, there is absolutely no possibility of anyone having a trade between the US and Russia. वहाँ सिचुएशन इतना खराब है कि मैकडॉनल्ड्स का जितना लड़ाई को लेना है उसको भी वहाँ से निकाल दो. So if you are McDonald's now, you will think thrice about setting up a new outlet in China कि भाई उधर फिर कुछ हो गया तो हमको तो यहाँ से बंद करके निकलना. So the confidence in China for business continuity is lost. So that is the beginning of the decline of China. उसमें there is no straight formula. It depends on the underlying situation. Sometimes, like typically at the start of a business cycle, inflation begins to go up, and because the demand is very strong, so central banks will gradually hike rates. At some point, the demand will get moderated. Now, sometimes the inflation is because of factors which are beyond the control of the central bank. Say if there is a food price ऊपर या wheat price ऊपर या उस पे वो कितना भी rate बढ़ा के, doesn't matter. So if you look at the current US inflation, it's a classic situation where Federal Reserve have no control on the inflation. So whether it is COVID-related disruption or war-related disruption, there is nothing Fed can do to bring down the inflation by changing interest rate. So what they're saying is that, okay, if the wheat prices have gone up, I can't help with inflation. But what I can do is I can reduce the demand by hiking the cost of funds. So at that point, they will say, look, if the inflation leads to higher rates, which leads to still higher inflation, at some point people will say, "Band karo, nahi chahiye," right? The second is a very softer aspect that, look, if I am a ordinary Indian citizen, right, and if inflation is 5% and interest rate is 4%, it doesn't matter why the inflation is 5%. My purchasing power is coming down by 1% every year. So, what is the best the Fed can or the RBI can do for me? That if you save, it will give you 6% return. The purchasing power is improved. Not so the incentive to save is spent less, which will then bring down the demand, right? So sometimes when you cannot control inflation, all you want to do is to give a higher incentive for people to spend less and save. So which is why what RBI does is only one part in terms of controlling inflation. So again, you have a classic example now in Europe, right? So in Europe, the energy cost has gone up. So सबके घर का इलेक्ट्रिसिटी बिल आराम से बढ़ गया. अब आप इंटरेस्ट रेट कितना भी बढ़ा दो, उससे तो कुछ होगा नहीं. So therefore, when the system is dealing with inflation, RBI has one role to play, which is called the monetary policy side of dealing with inflation. Then there's a fiscal side dealing of inflation, which is government will, for example, in Europe, they have kept the electricity bill of the household. In UK, in Germany, they will give subsidy to them. The COVID will get, right? So when you look at how a country is dealing with inflation, it is at two levels. One is at the fiscal policy level, the other is at the monetary. Right? So monetary can do, monetary policy can. So what you are saying is that the impact of inflation, impact of higher price is not distributed fairly and evenly across the value chain. But that is a problem where which is where the policy reforms have to come. For example, let's say they were bringing the farmers bill or other. Right? But So that is always there. See, that way, that's why it is such a complex subject that there's no one right thing or one right view. Right? There's always so therefore the more reform the system, the better. Right? Abhi, yes. Right, sir. Thank you, sir. Thank you, everyone. Thank you for your time.
Thank you very much.
Thank you, Jajoo sir. Thank you.